This is Siddharth Alwalia. Welcome to the 100x Entrepreneur Podcast. This episode is brought to you by Prime Venture Partners, an early stage VC fund led by Amit Somani, Shripati Acharya, and Sanjay Swami. Prime is often the first institutional investor in category creating tech startups in fintech, SaaS, healthcare, and education, such as MyGate, Quizzes, MFine. To know more about Prime, visit primevp.in. Today I have with me Samir Brij Verma, Managing Partner at Nexus Venture Partners. Welcome Samir to the podcast.
Thanks, Siddharth.
Samir, would you tell us more about your journey, how you became a VC and your journey till now at Nexus?
Sure, happy to. So I've been now in the venture space for about 12 years, really from the early days of the venture ecosystem now. Nexus for about 8, and before this I was in a firm called Reliance Ventures, which was a subsidiary of Reliance Capital, which was at that point of time India's largest asset management company. And prior to my career in venture, I was doing operational roles in high-tech companies in India, US, and China, essentially. I was with Ericsson and another telecom equipment manufacturer called UT Starcom, and started my career in a startup in Chicago. Did that right out of college. I graduated in '03 with a computer engineering degree, and I was right from college. I really liked tech, when I started working in operational roles, I kind of developed an affinity towards what's happening in the world of finance and venture capital. And I wanted to get into the space and then the domain, I looked at what would be the right answer to do that. And when I was at Ericsson, I started doing my CFA, so trying to learn a little bit about finance. I did my CFA Level-I at that point of time. It was the only thing that I could do along with the job without leaving it. And I started looking at a lot of the VC websites and looking at the kind of companies they were investing in. And that kind of completely drew me to the fact that you could do something where you would be working with early stage entrepreneurs, bring together an understanding of tech and also the whole financial angle to it. Started talking to a few venture firms. There weren't too many at that point of time, and most of them had this post MBA kind of a thing. I had known about Reliance because they were a customer of mine at Ericsson as well as at UT Stockholm, so I'd known about the group, and I got to know that they were starting a sort of a venture arm under Reliance Capital, using their prop book or principal investments group. That's how I reached out to them, and it actually worked out. Had a couple of discussions with them, and their idea was to invest into the whole technology space and India consumption. So when it comes to technology, investing into technology companies in India and the US, and the India consumption story. So I joined them in, it was a good discussion, and I was a founding team member, second employee of that entire vehicle to do these things. It was very different from what I was doing as a solutions architect at Ericsson, and then I had very little understanding of finance, knew very little. Obviously, tried to read up as much as I could, but I was like thrown into the deep end of the pool in many ways, starting off my career with Reliance Ventures. So really, actually, that was quite an interesting time because '07 was a very euphoric time. It was kind of similar to what it is now, but of course the ecosystem is a lot more mature, and the types of companies that are out there are a lot more mature now. But it was a euphoric time before the '08 meltdown, and so I got to the party where everybody was drunk, but really got first-hand experience of about how to build up the firm, right, and how to build up sourcing relationships. I didn't know what a term sheet looked like, for example. Learned all about that. Learned about how deals work. What are the kind of things to look at in a company. So it was really baptism by fire. It was only in '08 I did my first investment in a telecom equipment manufacturing company in San Diego called eBand. From there on, I started learning the ropes myself. And there weren't too many people to teach us. It was a very, very small team, but it was very, very highly entrepreneurial. So got an opportunity to work there for about 4 years, did a bunch of interesting investments. At that point of time, we deployed about $34-35 million in our life cycle as a fund, not too much. And fortunately for the vintage, when we started out, we ended up doing quite well. Just given how venture works, we'd invested in Paytm in 07, 09, we'd invested in Yatra in 07, we'd invested in a couple of these kind of companies because and those worked out to be pretty well. So honestly, the fund, if you look at the relative performance for some of the other ones out there, did quite well, surprisingly. And it was all a bunch of people who didn't know much about ventures. So it was, looking back, it was quite an interesting experience, if you ask me. And Yeah, it was exciting. I got to learn a lot at that time. All about how what to look for in companies, develop my own sort of investment checklist and the likes, and more importantly, look at companies sitting out of India in the US, and that was very exciting, if you ask me. Right, I really got an opportunity to understand. I was doing deep tech investments back then, so I learned a lot, and that was fantastic. I moved to Nexus in late 2011, and I was based out of Mumbai. And what I liked about Nexus was, again, it was a continuation of the same thesis of investing in the India-US corridor, or global tech companies, and also investing into the India consumption story. It was one of those funds, kind of an anomaly in the Indian ecosystem, and I really liked the people as well, and the fact that it was a smaller fund, so a smaller team and a smaller fund. We had just started the process for raising the fund 3 at that point of time. We raised our fund 3 in beginning of 2012, and so it's been a very interesting journey. I was in Mumbai for about less than a year, and then I led the charge to kind of come to Bangalore and open the office and presence here. And the last few years has been pretty exciting. It's again been a continuation of investing into really early stage companies. Mostly, I would say 85 to 90% of my investments at Nexus have been in pre-revenue, pre-product companies, and I've continued to focus on the same India-US corridor piece. I've done a bunch of interesting investments in that domain, in enterprise, all across the stack, right from infrastructure to the application side, as well as investing into the India consumption story, across, again, using companies which are leveraging tech to kind of build themselves out. So that's that's what I've been doing, and I've been having a lot of fun.
So Samir, if you could, share some moments where you were really, thanked God that you got into venture capital because of circumstances coming together, your interests coming together.
I think I thank God every single day. I mean, I'm very, very grateful for all that He's given me. I think just I'm a God fearing person, and broadly, and just as a personality, and I thank Him every day, because I love what I do. Even if I didn't get paid at the end of the month, I still do this. Or however rich I was in the world, or made as much money, I would still do this. I wouldn't go and retire off on a beach. So I'm very fond of what I do, right? And I really I'm very, very passionate about it. So it's so I'm very, very grateful for the opportunity, and then the people that I work with, and more importantly, the founders that I've had the opportunity to partner with. And so I think it's an everyday thing. I never curse the thing that what kind of a business is this. There are people who like instant gratification, but if you look at it, I'm not a personality who's oriented towards instant gratification, so naturally aligns well with being in the venture space, because this is a business which has long feedback cycles. It's a That's the unfortunate part about it. But personality wise, I can live with delayed gratification. But and when you work with entrepreneurs, you're exposed to pretty much anything at the stage at which we come in, right? So really working with them shoulder to shoulder to kind of help them think through all the risks that are out there, and try and mitigate those risks as we evolve the company and build a sort of P&L in due course. And that's a very, very enjoyable journey. And I think structuring all kinds of chaotic things and building company, enterprise building is hard. It is very, very hard. And I've been fortunate to do it now with 35 companies. Now I just concluded the 35th investment. Uh, I'm having a tremendous amount of fun, and it's got its moments when it's stressful and all of that stuff. But I never think like, oh God, why did I get into this? I don't think about it at all, because this is actually just what I want to do. It's one of those things where, I naturally gravitated towards this. I had no training. I have no godfathers in the industry. I have no, no prior understanding. Nobody knew. I'd only heard about Vinod Khosla back in the day, and how and kind of admired him from a distance, and looked at all the other investors, John Doerr, Michael Moritz, and all these guys, but I no connect to them or any of that before I started my venture career. So that's what it is.
And Samir, if you can take us through the companies from 2012, which you have led the investments in the Nexus.
So I've again, as I said, I've had the opportunity to kind of partner with entrepreneurs in both cross-border tech, India, US, and as well as companies in India. So on the cross-border side, I've had the good fortune of really partnering early with a number of these companies. I led the investment in Postman, which is a DevTools company. Another one in the same space is called Hasura. There's another company called Condal, which was in the alternate data space, which got acquired by Nasdaq. Then another one called Jovio, which is in the HR tech space, in the building this out of in the programmatic recruitment space, based out of here and Redwood City in California. So they're so that's one. There's another one called Good Era, which is in the enterprise giving space. Again, SaaS plus market network play. As well as there are other companies. There was another company that I invested in called Index, which got acquired by Avalara, which was in the product intelligence space. So those have been some of the companies which are on the tech side. Recently invested in a company called Goals 101 last year, which is in the transaction data analytics space, mostly oriented towards banks and financial institutions. So those are some of the enterprise companies. On the India consumption side, I have invested into, on the edtech side, Unacademy, which is India's largest test prep platform. Then there's another one called Zolo, which is India's largest co-living play. Jumbotail, which is in the wholesale commerce and new retail platform for food and grocery. Then there is another company called Myupchar, which is building the vernacular WebMD equivalent for India, which is health health access gateway for the Indian market, and has a teleconsult and telemedicine sort of layer embedded into it. Those are some other ones. Two more in the pipeline which are still in stealth mode. So those are examples of companies that have had the opportunity to kind of fund.
So on an average, you lead around 1.5 to 2 deals in a year.
I would say about two deals or two to three deals a year. That's on an average. Yeah.
Do you find the pace slow, because like evaluating those deals 2-3 months and takes.
I think given the nature of business and we meet companies every single day. My typical day I probably meet about 5 to 6 companies every day. So obviously, I am fairly selective about what I want to pick up and do, and so we end up doing things which we're very passionate about, right? And like, I'm fairly passionate about marketplaces and B2B commerce companies, and again, enterprise tech companies going global from India. So I think I stick to those kind of areas where there's some bit of competence or circle of competence built in, and try and optimize around those spaces. I think so. I think if you're doing the way any of these funds, our funds or any generally venture funds are structured is, each partner would do about 2 to 3 investments every year, and you would do that in every fund you would do about 6 to 8 investments. because you invest in the first 3 years of the fund, and after that you go out and raise the next fund. Because these 8 companies, and if there are 5 partners or whatever, there's fatality which comes along the way. In some of those cases, you'd be seeding them. So there, all of that exists, right? So I think that's a healthy number to go ahead and do things with. You can go out and be crazy, but then you can't add the sort of value that you want to add with these companies or do justice to them. I don't think we do operate with a spray and pray strategy where we're writing checks every single week or going crazy about things. We're a little bit more, I wouldn't say conservative, but we are a little bit more thoughtful about the kind of investments we want to do and the spaces that we want to pick. And, the nature of venture is that some of these companies will be disproportionately large, right? And not every one of them will be, unfortunately. So things work out. If you're focused on the right things, the right ingredients, it'll work out. And so, it works out, and some of them can return funds. And, I feel fortunate that every fund that I've been a part of so far, my investments have kind of returned capital of the entire fund. So I feel fortunate with that. I think that's a good barrier I want to stick with, and that's where I want to keep my qualifying criteria going into companies. That can these companies be large enough to take kind of return the deployed capital? So that's the goal that I have personally, and I think 2 to 3 a year is good enough for me to justify. As this year I've done, and the second one is in the works right now. It's towards the end of the year, so I'm fairly comfortable with that.
And what have been the 2 top companies of yours which you led in every fund since you came?
So I did in 09, as I said, I did Paytm. That was the top one. Returned the fund 2 times in as far as Reliance was concerned, a little over that. And the others were also all added up. They were decent returns. Some were decent, some were good, and some duds as well. So that was the case as far as Reliance was concerned. And in Fund 3 when I joined at Nexus, those would be Postman would be one, and the other one would be we'd invest into Roadrunner that got acquired by Zomato, so we did a share swap there. Fund 4, I would definitely say all Unacademy, Zolo, and Jumbotail, and Hasura, and Grovio, all strong companies. And Goats are all strong companies as far as returning the capital for, it looks very, very, very possible that we will return over $350 million of capital from that. Some are already marked up and are on track to be very large, sizable companies. And Fund 5 is early. We raised that last year, and I'm bullish about one of the investments that I've just done. It's not announced, so. And that's tracking quite well. So and still have some time. There's another one that I'm working on. So yeah.
And among the investments you mentioned, so Postman and Unacademy, I believe, have raised the largest significant next round of capital. Postman and both Unacademy being $50 million each.
That's right. Yeah, they have.
And there's an interesting.
But raising capital doesn't mean that they're super successful. But yes, it is some validation from the external world perspective. But both are extremely solid companies. I would say Postman is a very, very unique asset and fantastic team. I must say that they're building a globally competitive product out of India. They started off out of our office in Bangalore. We seated them, wrote them the first $1 million check. I mean, all credit to the team. They've done a fantastic job. They have 25% market share in the globally across the developer base, right? 8+ million developers use their platform. 400,000 companies use their platform. Enterprises use their platform. So that's all ground up adoption. Same thing with Unacademy. I think I would give all credit to Gaurav, Himesh, and Roman for what they built. They have, we wrote the first Series A check to them, our first institutional investor there, and that company's done fantastically well. We still have a long way to go, but I think we are really causing a disruption in the way the coaching center market and test prep market in the country. I think with the traction that we're seeing, we started real efforts towards monetization early this year and are on a pretty healthy wicket right now. I think we're scratching the surface, if you ask me. But I think it is getting to be a pretty interesting platform and a company. So I really love their approach. They've been fairly capital efficient. They've obviously always have a lot of interest so far from investors to kind of come in and participate into companies. So we have that. It's a good place to be in. But they've been fairly thoughtful, contrary to what people think, that they haven't spent as much money to get here. And I think our revenue is much more than the amount of money spent so far in terms of run rate. So it's pretty interesting. And for a company which has just started monetizing for 9 months. And a long way to go. I think these are some of them. I think there are others as well, which are quieter. They haven't raised as much money, but are executing quite nicely. Yeah.
There's an interesting story that when you went to Unacademy office for signing the term sheet, you didn't come back until the term sheet was signed. Tell us more about that.
It's a pretty crazy thing, right? I met Gaurav for the first time on a Thursday, and I think we signed the term sheet on a Saturday. I think that's how it worked, right? And I just met him. I just realized that this guy's an exceptional founder. Is very driven, knows what he knows, and knows that what he doesn't know in some ways. And I just spent as much time as I could with him to kind of do this. And it was competitive in terms of a thing, but I think it just came down to chemistry and our ability to kind of buy into his vision of doing things. And I obviously was dogged about it, and I think that's the nature of things, right? I think that's what I could give credit to the entire Nexus partnership. They stood by me when I was making both these decisions that you talked about, even with others, but those are not as popular, so you don't know. But I'm a fast decision maker in some ways, and if I take a decision, I just go ahead and do it. So I've been fairly fortunate that if I decide to do something, then I would kind of do it. And it happens mostly due to founder chemistry and affinity towards, people realize that it's a long-term journey, and that, they need the right partner in that, a patient partner who's always with them through the highs and lows. I think sticking with that makes a lot of sense. And I think entrepreneurs can see that. So fortunately, I maybe had in my career, I've had 1 or 2 situations where I didn't get to do it when I wanted to do it, and because I'd lost the deal to something, or there were some variables, like Freshdesk is one, where I was outbid by Tiger to do the round at that point of time, and I just couldn't get the requisite conviction in the partnership to kind of step up on the valuation at the Series A level. But there are few and far between. But generally, when I move, I generally try and close things. That's
So what was in Gaurav's case that motivated or inspired you to give term sheet within 48 hours, do the IC meeting in between?
I think just the guy. And I love the team. And it's not only Gaurav, it's Roman, and it is Himesh. And so it's a well-rounded team. Number one, the fact that they were building a free platform which was building top of funnel, and their approach towards totally decentralized cost structure. They had very strong platform thinking. Gaurav, previous venture hadn't worked out, so he knew what not to do at this time around. And Roman, obviously, extremely bright chap, understood how, and he was an educator himself, was able to draw in a lot of people. And when we invested in the company, company was only doing UPSC, right? And it was all free. And but we loved the approach that they were taking, because it was a YouTube channel moving to a platform. And we knew that that these guys could pull in the requisite kind of teachers. We were seeing some bit of early signs that that they were onto something special, right? And they, the way they were kept their content, it was just like short bite-sized videos. People were consuming those. We were seeing some good metrics at that point of time that made it happen. But if you ask me, I'll put everything aside. It was just the team and the market opportunity. It's very, very obvious if you look at it, right?
It's not obvious, but taking
back
that
then also it was kind of obvious, but it was an unconventional call, because a lot of things have happened over the years which have kind of led to that. Whether it's a geo effect, payments, all of that has really added fuel to the fire. I won't take that away from it, but they had a mobile first approach, right? If you look at the coaching center market, right, if you think about it, 80% of the people in the coaching center market are in remote areas, right? They have to come to cities to study, and there's no coaching centers there, right? So like for these test prep exams, people move to the cities, right? Only 20% of them are taking coaching classes. 80% of them don't have access to it. They have to move to the city. And that's a pain, right? And that's an access problem. And what can solve that access problem? Clearly, technology could potentially solve that access problem. And which is why, it made sense to do that. And there were early signs that people in these small cities were using this platform to get access to the best kind of content which existed and from other people, right? And it was free. So we could see the top of the funnel getting created very nicely. I think that's what caused.
It was a pre-revenue company, so
It was
a risk.
pre-revenue, absolutely. We didn't make revenue all the way up till 2018 late, right? And full earnest monetization only started earlier this year in February. In fact, 30th of Jan was when we launched the Unacademy Plus version of it, which is the live streaming kind of thing. And since then, it's become a range, right? It's grown really fast. So this was monetization. Just the market dynamics around it, and the fact that it was very clear that technology could play a very strong role in this market. And then they were winning very deeply into the UPSC category, I think. And if you look at government exams, there's a big amount of commonality across different kind of exams. If you prepare for one exam, there you could probably take, you could be decently prepared for the SSC or any of those. Not everybody gets into UPSC, right? But there would be other kind of categories of exams. So when we did that analysis, although it was short, it was 2-3 days, but I have no regrets in doing that because, Gaurav did a great job in telling us about all that existed, and it was a founder-centric investment bet, right? I think we're very happy we're still large shareholders in the company today. And more importantly, I think these guys are just getting started. I think there's a long way to go. And I personally feel they'll build a pretty nice company here.
And today, I believe there are more than 50,000 paid subscribers for Academy Plus.
Almost more than 70,000 plus.
This is such a short time, like
Yeah.
9 months back.
I think we haven't advertised or done any of that. We've just had some campaigns, but once we do that, it'll grow even faster. I think we're just getting the right things, the house in order in other exam categories. We've launched NEET, we've launched a bunch of other new categories, and I think we're just getting started. Honestly, we're scratching the surface. It's a very large market. I think we need to be synonymous with test prep in the country.
And how big you believe the test prep market in the country is today?
I mean, there are many ways to slice and dice it, and I was reading the last. There's some KPMG report which estimated it to be 4.5 billion in 4.5 billion in 2016, which was early part of 2016. That's what the estimate was at that time. I believe my gut says there was another report I actually came across about a month back, which was saying $7.5 billion market, and my sense is it potentially is closer to 10. Because it's very unorganized, extremely unorganized, right? And some of those numbers don't get reported with very small coaching centers and all that stuff. Those numbers don't get reported at all. There are many reasons for that, right? Tax issues and all that. So none of that gets captured here. I think it's a fairly large market. But if I look at across all exams, right? And today, Unacademy is I think about 23 categories of examinations, right? We started off with UPSC, but we have like NEET, we have NDA exams, we have GMAT, CAT. All of those exam categories are now, each of them can be large verticals if you have to build them out. We're just putting all the requisite people in and getting the platform up and running. We're doing closer to 2,000 live classes with several hundred people in each of these classes now every day. So it's just starting, I think. But all the credit goes to the founders. I think I've been fortunate to partner with them. So.
And let's take us to the Postman story. There you had a bit more time since you incubated that team.
No, not really. So it's a pretty funny story there. So Abhinav was developing websites for a living, and he had Postman, which was a side project, open source project that he was running, and this was a plugin, browser plugin kind of a platform for developers to test their APIs, right? And I reached out to him. I got to know about him from one of our portfolio companies. The CTO told me a little bit about them, that they were using this tool, and he mentioned that they are in India. He said that it's a pretty popular tool, and I said, okay, let me reach out to them. So this was actually in 2015, July 2015 or so, July, August 2015. I reached out to him, and I remember meeting him at Leela here in Bangalore for the first time, and absolutely exceptional guy. He was just doing this as a side project, and he had two other people who were working with them on this in building out Postman as a platform, but they were moonlighting. They were doing full-time jobs. And 40 minutes into the conversation, when I heard his entire vision and everything else about it and how he planned to build this to be a independent and large company, I told him on the spot. I hadn't even got him into the IC or any of that stuff. I told him on the spot that we are keen and that we would like to take next steps and invest into the company. He had a buyout offer from a company at that point of time, which he was considering, which would have made him very rich. Rich.
It's a relative term.
It's a relative term, but he would have made a couple, $1 or $2 million as a result for just a side project. And the other option was taking on money and actually building this out. And he was a young guy, right? And obviously he had a head on his shoulders, and was able to convince him that don't do that, and let's go out and build this company. And I think I got him into the office the very next day or the next to next day, 2 days out, and he was talking to a bunch of venture firms, and without a investment committee meeting or whatever, I had another colleague of mine, Sandeep, join in for that meeting, and we didn't let him leave without signing the term sheet. So pretty much, so we hold in and closed on that term sheet then and there, and that's the first day when I actually got to meet with his other co-founder as well. They'd come over as well, or his proposed co-founders. So the term sheet actually said that the name of these three people and any company that they start. Right, there was no company or whatsoever.
There was no private limited.
There was no private limited company. There was nothing, and I just feel blessed that they decided to partner with us, and it's been a remarkable journey from there on. I think I have an immense amount of pride in how they built out the company with the frugality and the innovative mindset and product-led thinking. I think post that, once we signed the term sheet, we started the incorporation of the company and all of that, and then they actually worked out of our office. The other two co-founders left their jobs and joined us. They put the and the company started out of the Nexus Bangalore office. So that's the journey. And 1 year out, we then did the Series A investment in the company.
And you did the Series A 5 million check, and
it was a 6 million check reservation.
wow.
So it's been very interesting. I think those guys, there were early signs even when I met him that they had about 300,000-400,000 developers on their platform using
at that point of time without even a company.
Without even a company, yeah, it was just a project, but it had love in the community, and from there on, I can tell you one thing, that Abhinav is one founder that has executed every single thing that he told me in that meeting even today. It's like that vision unraveling. Every single thing that he mentioned is exactly how it has played out. It's uncanny, and it's amazing. But yeah, I think Abhinav, Abhijit and Ankita are fantastic. I think what's more amazing is that they've stuck to the core. They've not got distracted. They maintained a low profile. They built a fantastic culture of engineers here, and they've been very low key and shunning kind of media publicity and all that. Just building out a very, very unique company. So, yeah.
And this has been your signature style, Samir, right? Getting companies to sign then and there, I believe, or to win the deal. I really appreciate that. You're a very high conviction person. Like you don't, when you believe, you just go in it.
I am. Yeah.
Getting the founder to sign it without him checking with a lawyer, whether term sheet is right or not, the conditions are right or not.
Yeah, I would say that I'm fairly high conviction, fairly competitive. Yeah, that's one thing that I would say. But I'm fairly, I think, once I'm convinced about the person, see, this business is all about three vectors, the way I look at it, right? And I only look for three core vectors. I think it's great founder, a founding team, very, very good, high quality people, very large market, and a very strong iterative mindset towards solving the problem. I don't like rigidity. if these three criteria are there, I think those are kind of companies. But it's not that I don't make my mistakes. I've made my set of mistakes as well. So, I've got companies wrong as well. So, but yeah, been fortunate that, I'm as passionate as like with the entrepreneur about their companies and their vision and buying into that vision. And I think the founders can see it, that, this person will stand with me thick and thin, through thick and thin, and be with them in that journey. I think it's just a very, very hard journey. I think it's all gets glamorized when the media reports things, and these funding rounds are put even more pressure on the companies to get bigger and better and all that stuff. It doesn't mean, it looks all fancy, but what goes on behind the scenes is like, there's a lot of expectations that each of these companies has to deliver against newer set of expectations, newer set of kind of capital providers who are looking for the company to grow and meet their expectations. Things change. So, and lots of times things don't work out, unfortunately. There would be many reasons for it. So. But yeah, my style is high conviction, and I think founders like that. Founders are fond of the fact that this person believes in us. I think when somebody believes in you, it shows. And I think it's not that because I'm scheming and plotting to be on the cap table because it's financial, but it is, I really want to be a part of their journey. Yeah. So.
And have majority of those 15, 16 deals that you have done in the last 8 years been like this?
I would say so, yes. And in situations where I wasn't convinced, like or where I wasn't fully there, I could make out and I didn't proceed with those. Good or bad, time will tell. But yeah, I've been fairly aggressive on things.
So only Tiger has been the one where you have lost.
No, I think Fresh Test got lost. I have tremendous amount of respect for Girish. I think he's a fantastic guy. I really wish I had partnered with him. That one I saw very up close in person. At the Series A level. But yeah, I think I lost out because of valuation. Not that, and I think Tiger would have still won because of the speed and aggression and all of that stuff. But we were not there in terms of valuation. Company still was very early at that point of time. So
because still today, even Tiger and Tencent give blank term sheets.
Yeah, it's a good model. I think Tiger is you have to respect them. I think I don't think they're crazy. I think they've. They started out, I think, in 2001. They raised 15 funds after that, if I'm not wrong, 15 or 16 funds. They've done fantastically well getting right markets, being in China, getting the cycles right, being in right companies. And, and I think, again, when Lee was there, I had a tremendous amount of respect for how he operated. I think speed is good. Speed and conviction is good. I think those are two things that matter, right? You can't get everything right. I mean, there's, you have very limited information window when you're doing these things. So, but I think net, I think they've made money for their investors. They've helped the ecosystem in some ways. When the entire ecosystem was building and giving $2 or $3 million checks to companies, these guys came and were capital providers who gave in a lot more, and got these companies to think bigger and at a larger scale. And he obviously transported his learnings from China and other parts of the things. And Scott and team are doing a great job as well. So I think I don't look at them saying that they're accelerating the innovation things. Of course, if you have the right checks and balances in some of these companies, and you're doing this with mature founders, it's all going to work out well. And if you're in the right spaces and all that stuff. So.
And Samir, if you could share, what have been your learnings from the mistakes which you have done, which could be valuable to other entrepreneurs or VC listening to the podcast?
Sure. I think the biggest thing is that you just cannot be fixated on opinion, right? I think when we're funding companies, there's a hypothesis in terms of what is the market, what is the product going to be. It's a hypothesis testing phase, right? So where I've made my mistakes in terms of entrepreneurs is that they have a hypothesis, but they stick to that and make that the approach by which they will go out to and build a company. I think my failures in investing have been where I did not read the entrepreneur's ability to adjust to market. And they were too rigid and too stuck on the process and too overwhelmed with their approach or too into their approach and couldn't take outside in feedback. And they read the market very wrong, I would say. And that's what happens. So, get rid of rigidity. I think that's very, very, very.
But were you able to identify the changes in the market while they were not at the same time?
I think so. I think so. It was, but the problem was that some of them unfortunately couldn't see it. It's not because I'm a genius, but they were very apparent. But some people,
Because they are deep down into one problem and you are seeing like 10 problems at the same time.
but that doesn't make me a genius by a far shot. But those are fairly obvious. I could go back into that. The other thing is that I think I'm also made mistakes where I've invested into people who are kind of corporate executives, and just thought that corporate executives could build startups. I think those are the things. It goes back to the same rigidity and agility kind of point, because they were just stuck in doing things in a particular way, or they were mimicking, building out companies or startups in a way in which they were doing like their own functions or divisions in large companies. They never oriented with the company with very fast on the feet kind of people, but more of the same large big company thinking. Those unfortunately haven't worked out very well for me. But I've seen a better trend of entrepreneurs who go on build companies and come back to become entrepreneurs. Those guys are far better. So that's the positive. So I would say those are better guys. But corporate executives building companies, I haven't had very much good success with. So those are two things. Again, goes back to this whole thing about rigidity, because we won't invest in a company which has ideally a small target market.
But it's also said that the markets of future are not visible today. Right? If everybody knows that these markets are very large, everybody would enter. That's where a venture capitalist who wins is, he's able to identify those markets which will win. So how do you see that some markets which are small today but can become large? Like it's very subjective.
It's very subjective, as you rightly point out, Seth. I think the way to read this situation is that I think there are some secular trends that you can read that are there on the market, and there will be a delivery mechanism of the company or some kind of value migration happening in the industry where it's moving from. There's some secular shift which is happening. It could be early, but there could be early. There could be things like which would accelerate that process, right? I mean, going back to when you started your venture, it was very early. It was very early days for what you started.
Yes, medical records back in 2003.
Exactly. So things weren't digitized. Things weren't. A lot of the platforms didn't exist for doing a lot of those things, right? So the timing of that thing might have been slightly off, right? Compared to if you have to start it today. Today it's there are many stakeholders willing to monetize on that data and do things with, potentially, if you do things well, so that you can monetize and make a relevant company today's time and age. But that's happened because of proliferation of many different things, right? Moore's law has been helping all of us VCs in many ways, right? So that's there. Bandwidth, all the plumbing which has gone in for payments, logistics has become easier. All of those things have become easier. I don't think a company in e-commerce could have scaled as well if it was in 2007 in India. It would have. There were early signs. The yatras and the make my trips were the early signs of transaction level booking. But the e-commerce came in much later when there was proliferation, and this really accelerated in the last 3 to 4 years. So it's also about market timing. It's not only about just doing things which are which might sound intuitive and right, but it is about getting the market timing right. And what could be the vectors of change? What are the value migration vectors impacting or working in favor of that thing to work? Right?
So have been times there where you said that this market will take time to mature and you said no to founders, but you saw, within 6 months, 1 year, things accelerating beyond your understanding.
It's a good question, but I don't. I didn't see those companies, but from a distance, probably I didn't hear the founder stories in those cases. Like in MPL, I didn't hear the founder story, but I thought that would take a little bit more longer than what it was. There was a pent up need, but I didn't think that they would be able to monetize as fast as they have. That would be an example, but unfortunately, not a situation where I was in a meeting and I couldn't get convinced whether the founder is saying something that I couldn't really fathom. Something that hasn't really generally happened, because I'm also equally optimistic about things. Too optimistic is a challenge at times rather than being pessimistic. But I'm pessimistic about approaches where technology is not being used and there's a lot of brute force and a lot of massaging of numbers to show traction, but which is not scalable. I would like to see a company which ideally uses technology in a significant way to kind of grow.
And it's very less talked about in an ecosystem. Like you rightly said, when a founder raises a $50 million or $100 million of funding, the kind of pressure it puts on the founders, right? Just and because in almost 99% of the cases, the founders have never built this scale before, or are the kind of expectations of them. What do you do in those cases? When you are with founders.
I think you have to keep a very strong intellectual honesty framework with the founders and make sure that they realize the situation and realize the most of them are smart enough to see it. But if they're not, then reiterate that and say that um, they got to keep their mind focused and heads down in terms of execution. It's very easy to get distracted, right? And I think that happens.
Everybody wants to open a champagne bottle with you.
Yeah, exactly, and it is a lot of people look at funding as saying it's a great outcome. It's not. It's an input into potentially making the outcome a lot bigger. People don't realize it, and it's very short term. It's a good validation, but that's the case. See, the one thing that you need to understand in venture is that if there is also a person who's coming with this kind of a check or not that, he's got a trained eye in terms of what needs to be done as well. So, the stakeholders around the table in these scenarios are essentially people who are not really early stage investors. So they themselves have seen this journey before and they bring in that framework of accountability as well going in. So ideally, if that framework of accountability is adhered to, then the company is going to make progress. And we just need to keep the guardrails on for doing that. And the new investor also is going to bring that new growth stage perspective to the startup. So, and that's what we try and surround that kind of skill set in the journey, right? Because we as early stage investors also in some ways tap out in terms of understanding how a company beyond, let's say, a couple of $1 billion will go to the next. So, Lee, for example, had that skill set at Flipkart. So he did a fantastic job from Tiger's perspective, navigating that transaction, right? So you bring in different stakeholders and they take care of things, and they've seen a lot more of those kind of situations in their career. So,
And it's almost the last quarter of 2019. Many people are speculating that it's a bubble right around the corner, or there's too much money flowing into the ecosystem. What's your take on it? Where are we headed in the next, let's say, 12 months?
it's a good question. I honestly I feel that the quality of the entrepreneurs that I'm seeing today, I haven't seen that for a very, very long time. So the quality of companies that I'm seeing, or all of us, I'm sure, are seeing are fantastic, right?
And what's the reason for that?
I think a lot of people have had their first ventures, moved out, come out, and are doing their second ventures. They've seen some bit of scale in some of these companies. They've been part of companies like Ubers and and Airbnbs and all of that stuff. They've come out and now have seen that global scale. People are moving back from the US are here as well. So I think that's a given. I think that's the good part. That's a really, really good part. I think we've been in a very unusual time over the last I would say 7-8 years of extremely high degree of liquidity and a lot of money floating around, and that's obviously come its way into the whole venture ecosystem. All the funds have raised a lot of money, so there's a lot of liquidity and there's a lot of hype right now. I personally feel that I'm very bullish about what will happen in the country, and I think there are a lot of confluence of good things which are happening, which will build some very interesting large companies. But those will be non-obvious companies as well, I think, right? I feel that there have been a lot of bad behaviors which have got reinforced in companies over the last 2-3 years since this mega bubble which is coming. And these companies are not focused on unit economics, but are just focused on scale without any kind of unit economics. I think those companies will start having to kind of get a reining themselves in to kind of doing something and behaving themselves. I think that is going to be essential, right? Otherwise, there will be flare-ups and blow-ups because these companies can't raise money because they don't have an economic model. So there's a lot of subsidization of the customer, which is happening right now by burning through a lot of money. And that's not a sustainable thing, especially in spaces like B2B and, certain other spaces. The subsidy economy which is going on right now, showing a lot of traction, which is great, but that is not necessarily going to convert, that scale is not necessarily going to convert into a solid P&L. So I think companies which are not orienting themselves in that way haven't variabilized cost, don't have a good handle on their cost structure, and don't have a good handle on being able to kind of make money from their customers, or have very high CACs but no LTV commensurate with it. I think those companies are going to see trouble. I think the environment is starting to shift. It is starting to get more cautious. I can see that. On the early stage side, I still feel there might be some, interesting fundings which will happen, which will be slightly larger, because the quality of entrepreneurs which are coming back are repeat entrepreneurs or things like that. So there might be some bit of interesting things happening there. But I think on the growth stage side, again, it's going to become a little bit more cautious. And I think there's a sort of a lag time, I would say. But I think by May, June of next year, I think things will be very, very, very cautious, I would say. I mean, that's my gut or reading on it, with US elections and all of that stuff.
India to China, or US China.
All of those things will kind of play themselves out. Global liquidity will, all these things are also about venture allocations and things like that. All these pension funds are allowed to relocate. The capital markets don't do well, or for some strange scenario, then they all reallocate their capital. So a lot of the hedge funds will start having to reallocate the capital in many ways towards public stocks, and they can only own a certain amount of venture assets. So a lot of readjustments will happen in terms of asset allocation, which will cause and if the liquidity dries up at the same time, will cause things to slow down.
So do you think it can be another 2008 when you started in venture?
If you ask me, I hope so.
Why?
I think there are a lot of companies out there with very bad behavior. I don't think they stand a chance. If you ask me, they just poked around with just unnecessary slush money. I think there's just some really shitty companies out there. I genuinely believe in that, and I think they're just you can't make out that they exist. It's just subsidized so heavily on venture. They don't have a unit economic model, and it's all promise, very large promise, or something or the other will come out. There's generally the value creation that some of these companies are doing is pretty poor. If you look at it, you can buy into a public company with much better multiples, with immense amount of liquidity, with better business principles than a startup. You won't get growth like that, but that growth is all random, right? So that reallocation is going to happen. I think I can see that happening in India. I think there are a lot of crappy companies out there, if you ask me. They all position themselves as decacons, and there are no moats in their business other than capital is the competitive advantage. The day that goes away, they're not building a great service. They don't have happy customers. I don't know what the hell they're doing in so many ways, right? So I think all these VCs are hanging around saying that, beating their chest, thinking they build great companies. I don't think they're enduring big companies. So fundamentally, I come from a different school of thought. So, that's unfortunately my thing. So I think things will turn. I think they will turn. And I really hope they do. Not for anything else, but because we shouldn't have this kind of bad behavior. We shouldn't have capital as a competitive advantage. We should have execution as a competitive advantage, strong moats as a competitive advantage. Capital will align itself behind that. It's not because of. It should be more for real reasons rather than some of the random reasons which are out there today. Yeah, you can't have the large funds distort the market and steal away the market just because of things. I think WeWork is a great example. It's unfolding in front of us, right? So there'll be
from
others.
$40 billion expected valuation to
47 was the last round. I think
Less than 10, not even getting less than 10 on the public
I
market
don't know
right now.
what the thing would be right now. I don't know, but it just shows, right? And there are many others like this. There is VAG. There's a bunch of other companies which are seeing these kind of problems in the thing. I think they're all getting hidden right now. But the day liquidity dries up, I think you'll be staring at a lot of problems. I don't think genuine business. There's genuine business in some of these companies. There's no P&L. How do you build a P&L? See, we are getting tricked and fooled into things that these companies will get built out someday. It'll happen. All that great thing will happen, and there's going to be these big companies. I think how many companies has the Indian ecosystem taken public? I mean, it's really difficult to take a company public because people want profitable companies. They'll sacrifice some bit of profitability for growth. The cash flows on some of these companies are horrible. So I think I'm not super bullish with some of the ways in which we are building companies. Every fund has some really good companies in their portfolio, and I think we all have bad companies also in our portfolio. And I think honestly, we all know which ones the bad ones are and which ones the good ones are. And I think all of us are overall doing a great job. All the funds doing a great job in terms of bringing out the next crop of good companies. I think we all generally have our hearts in the right place, but the market is distorted. I personally feel that.
And why do you think VCs traditionally in their behavior are not building companies for public markets? If the goal was end goal was to take the company public, there would be much more governance. It would conflicts with the VC model that you have to return your funds in 7 years. Thereby, you need a higher bidder or a bigger investor like Tiger, SoftBank to come into your venture quickly. And
I think if you look at it historically in the last decade, I think most companies have delayed going public, right? And that's clearly which has happened. And that's because the availability of late stage capital is there. And when you have that availability of late stage capital, you can be private for longer. You don't have to report to people that often. So that has been a sort of market distortion factor which has played into the thing. And when you're private, you don't have to focus on corporate governance to the levels, right? And it seems like these guys don't. It seems pretty apparent that these big funds are not really focusing on or ensuring that there is a lot of corporate governance. Seems like it, right? And I don't know, it could be wrong, but seems like it.
but growth at any cost.
Yeah, and because and they are all pushing that become really large companies and scale and all of that stuff, and then we'll take you public, and because you have this kind of scale, everything will be okay, and people love growth. I think if you look at US markets, people love growth, but they love to see growth with a unit economic model which makes sense. In some of these businesses, whether you look at Uber or you look at Lyft or you look at some of the companies that have gone public, they don't have a unit economic model which is very resilient. If you look at it, right, they don't have that, right, and they've been dependent on equity has been in some ways cheaper than debt for them, right, and that's why that thing has become really difficult. The leverage in most of these businesses comes from if you have a strong unit economic model and you can raise debt and you can do good things. All these companies on the BSE stock 500 have been built on debt, right, and because they had a good economic model. A lot of the companies on NASDAQ, these hyper growth companies, have been underperforming or below their IPO prices because they essentially haven't built a good model. They don't have defensibility or a large margin of safety in some ways in terms of their gross margins, which can take on competition or which can take on, or they've created so much bad behavior in the ecosystem, whether it's with drivers, whether it's with supply people, that it takes a long time for that bad behavior to get corrected. And when you have that, the growth also goes away because demand side has got oriented towards a different thing. You're seeing that classically happening in Uber right now. As they're focusing on profitability, the service has gone for a toss, right? And I can tell you both these Olas and Ubers of the world are not growing as fast as they could. In some cases, I believe they are degrowing, right? So it's a secular thing that these companies have to focus on profitability. Ultimately, the business principles haven't changed forever. We have been in a distorted market, and we just feel that things are all hunky dory. The moment the tide goes away, you'll get nose naked, right? I think it's going to happen. I really hope it happens because I don't want to be orienting companies which don't get to be sustainable large companies. If you take out and take the unicorns in the country, if you take out the external funding today, I don't know how many of them will stand up on their feet. They can't. That to me is a big, big red flag. I could say that with Freshdesk, I could say that with Postman, I could say that with a few of the other good companies that they'll be able to manage their plans and costs and everything, and they've got some scale and things like that.
But consumer companies, like if you take example of all the consumer,
They don't have a unit economic model. Majority of them, they don't.
so where will they go? Like ultimately,
They'll have to focus on the basics. I think that's what's starting to happen. If you look at Uber, for example, fired a lot of people, fired staff in India. All of them are. Everybody's trying to get their act in order. I think because people can see that the environment will change, so things will not be as easy.
so last decade for venture funding, especially belong to storytelling founders, those who could tell big visions and big stories.
Yeah.
Right.
Unfortunately.
Yeah. What do you think? Like as per your focus,
I haven't invested in many of those guys. Fortunately, unfortunately, I think market perception is unfortunately, I think fortunately. I have made an effort to kind of potentially invest into founders. And of course, I've got companies wrong. Please don't get it, think that I've got everything perfectly fine. I've made a lot of mistakes. But try to invest into founders which are building a genuinely good business, execution oriented, good business, and timeless principles around how to build it. Maybe we compromised growth around it. I haven't discounted to get GMV. I've always charged commissions to get GMV. Try to get to a unit economic profitable model. At least we tried to. We haven't just raised money and just try to get scale and just fool people around. So
the Nexus partnership has been building companies like Dhruva
yeah,
Capital, and the next is Delhivery.
yeah.
So what have you seen?
We have some very fantastic companies. We're just very low key people, so it
If
doesn't
you
come
can
out.
tell just more about that, because we are towards the end of the podcast.
Sure, I think I think we're fairly fortunate. I think we've had some bit of misfortune with some of the companies, unfortunately. But I think we're coming back very, very strong. I feel very good about some of the companies that we funded. As you took the name of that. For every fund that we've invested from, I think we have very, very interesting companies emerge, right? Whether it's a PubMatic or a StudyMac in Fund 1, that when we started out, and we've already returned much more than a majority of capital from that fund. We got two of those big value drivers there. We've got some very interesting value drivers in Fund 2, which is Aryaka and the likes of Dhruva. And of course, it's that Snapdeal is coming back from where it is. We stood by the company through thick and thin. Unlike and showed character as a venture investor, we didn't just throw them under the bus. We stood by them through their journey. I think and we've already got almost 4 exits from that fund. We've given
Which one are those?
So we've done Gluster, we did Cloud.com, and then there was NetMagic, and then there was one more. It's not coming to my mind, but we
all US based.
No, these are all India. NetMagic was India based.
For example, majorly focused on the US.
No, majorly focused on India. Very much focused on India. Dhruva was actually sourced out of here in India. It was an Indian company that we kind of made go to the US, right? Aryaka builds all its product here. 90% of its engineering is in Bangalore. So I think this is a perception that our competitors and all of that want to play this, that we are a US fund and all that stuff. But all of this has an India connection. So we have a couple of value drivers there. As in Fund 3, we've got a fantastic portfolio. We've got Postman, we've got Delivery, we've got H2O. We've already exited 2 or 3 companies from that fund as well. We have India Shelter Finance. Fund 4 is again very interesting. We've got of course Unacademies and Zolos, and Turtlemint is doing exceptionally well. And a bunch of very, very interesting companies which are not publicly known but exist, whether it's a Minio or Rancher and some of those companies exist in that, and they're all scaling really, really nicely. And I think Fund 5 is, of course, we're on track as well. We've got lot of interesting companies that we've partnered with. If you look at it, we observe is doing quite well. We have Rapido, which is coming along quite well. White Hat Junior, which is doing well. We've invested in a company called Cibros, which is in the automotive cloud. Ask Nicely, which is again a very interesting SaaS company. There's another one that I've done right now, which is again growing quite nicely, which is still in stealth mode, a B2B company. So I think we've got, every fund we have a couple of very strong winners, clearly identify that we are doubling down and scaling with, and I think we just don't go out and market ourselves.
Yes, that's what I was about to ask.
As
Except
well
a
as we
couple
should
of
do.
consumer companies, you are not, for the other companies, you are not being, in the public eye as much.
Yeah, well, I think we're a very small team. We just focus on the basics. I can see if you're probably talking to me, you'll realize that I'm like, I would have said P&L more than any VC would have said, right? For me, people call me a PE VC investor, right? Because I have that lens of saying that how will the company make money ultimately. I am very clear on doing that, because ultimately there'll be all hypes and markups and all that stuff. But if the company doesn't make money, it's all a waste of time. I think we've just wasted an immense amount of shareholder wealth in doing that. And this is not the first time I've seen 3 cycles in this ecosystem. You've seen immense amount of wealth destruction that happens. I graduated in 03 when the .com bust happened in the US, right? So those memories are still so clear in my mind. I saw 08 being on boards where we had to fire people, right? And so I know when things can go wrong, and all of us are fairly rational about doing these things and doing things more thoughtfully rather than just we have a fiduciary duty not to waste our investors' money, right, or doing random things, to build good enduring companies. I think that's what our focus is as a fund. But yes, I agree that we've not been marketing ourselves. We're starting to see some of those changes happen, but we will. I think some of these companies will do very well, and 99.9995% of the credit goes to the founding teams of these companies. We are enablers, and we realize that we don't go out and be larger than life and say that we take credit because we are so smart and all that stuff. I think founders deserve all the credit in this.
And how big is the Nexus team right now?
Fairly small, yeah. We have 3 people in the Bay Area right now, and we have 4 people in Mumbai and 4 people in Bangalore. That's it. It's an 11-member team, very small. We are India's largest homegrown fund, manage about $1.6 billion.
And 80 portfolio companies?
80 plus portfolio companies, yeah. That's growing. Yeah. We haven't announced a couple of our investments yet. I think we have almost a pipeline of about 6 investments which we haven't announced. So those will be announced soon, and you'll hear some very interesting things coming out. So,
And the last question for our podcast. What are the key principles that you have learned from Sandeep, Naren in the Nexus partnership that you could pass on to other junior VCs in your firm?
So one thing is, very unique about the fund. Unlike other funds, we don't have a hierarchy. We don't. That's one thing that you realize. We can have titles, but I think none of it is there, right? I think I do as much as of sourcing or things like an analyst in our firm does, and we are full stack in our own ways. All of us are full stack. Obviously, we will have learned through our journeys and done things, but my sense is we don't have that kind of thing. So that culture is one part is very. The other thing is that we've kept a culture of radical openness in terms of telling each other what works, what doesn't work. I think the focus is more the content and rather than it coming at a person. So we learn to decipher that, or that it's not about a person that this feedback is towards, but it's about the opportunity and what needs to be done. So it's a sort of a culture of very open thing, because it's a small team, so we can talk about things. It's fast decision making. I think I think these are cultural undertones of the fund which have kind of held on things. I think one thing that I've felt about Nexus, which unlike other firms, we don't throw companies under the carpet or rug when things are bad. We just try and stand with them, and that's how institutions go through all their journeys. We are a 12-13-year-old institution. I think we will go through our journeys. When things have gone bad, we've all come back stronger. We've all come back knowing where do we kind of now do things, what are the mistakes we made. I think one great thing about us is we learned what's wrong, what are our strengths, what are our weaknesses, and that sort of intellectual honesty framework is in place for us to know what to focus on. We don't want to market ourselves just because. I think we want to stay very close to the truth. We want to live in a fallacy world. I think that's what I would say. That centering is an important part of the Nexus team. And that's the foundational stones that all the founders have set. Yeah.
Thank you so much, Samir. It was enlightening to have you on the podcast.
Thank you so much for coming over, and great chatting with you. Thank you for your questions.